like not thinking energy. So because we never had a proper money, then I don't think any classically trained economist could have developed an engineer, a physically grounded or mathematically grounded understanding of monetary economics.
So they have to learn from you.
Well, what happens next is, since they don't have a physically or scientifically grounded basis for monetary economics, then you don't have a scientifically grounded basis for economics. And that means that everything that follows, which means corporate finance and investment theory, is also not scientifically grounded. So what you have is people, there are people working to develop, call it a particular solution to a problem, but not the homogeneous solution to the problem. And a particular solution to the problem is a set of rough guidelines that work only for a certain amount of time, only subject to a certain set of assumptions. So, for example, Warren Buffett is the greatest investor of the last 50 years. Warren Buffett's investment advice is limited to picking stocks, equities, primarily equities in the United States and the U.S. dollar system. And occasionally he utters a few words on real estate, and he talks about commercial real estate a little bit, but mostly just equity picking, stock picking. And of course, if you think about that, you think, well, what are the assumptions he made? Well, the assumption is the United States won't fail as a country. The assumption is the dollar won't fail as a currency. The assumption is that companies will be allowed to exist by the political system, and the U.S. won't become communist. Because if the political system shifts, companies don't hold any economic value at all. The value of all equity goes to zero in a communist system, right? Right after Lenin or Stalin or Castro took over, there is no capital value in any stock. So you have to make an assumption about the political system. But then again, if I take you and I drop you into Weimar Republic or Nigeria, or let's just take Argentina. Argentina in the year 2000, and I give you $1 million, and I say you can buy anything. Okay, well, buy any company. Let's say I constrain you to buy companies. Well, what's the winning choice or winning strategy in Argentina if you're limited to buying equities in Argentina? And the answer is there isn't any. There's no, even if I made you God, even if you knew the future, if you could go forward in your time machine 24 years, see exactly what's going to happen, and then go back to the year 2000 in Argentina, if I construct the system, or I construct the model such that you have to pick from amongst an infinite array of companies, there is no winning solution. They're all losing, because all companies are currency derivatives, and the Argentine peso goes from 1 peso to the dollar to 1,400 pesos to the dollar, which means that anything valued on cash flows is worthless. So here, we didn't see the political system go communist. What we saw was the currency goes to zero, and if the currency collapses, all currency derivatives collapse. So let's expand the investment model or the range of investment choices, and let's say you can invest in not just stocks, but you can invest in real estate or commodities, or you can invest in in bonds. Okay. There's not a single bond that pays off in pesos that doesn't go to zero. There's not a single piece of commercial real estate that pays you rents in pesos that doesn't go to zero, because they're all currency derivatives, and they're currency derivatives correlated to the ARS, to the peso. So if I have a time machine and I go forward and I know that the peso is going to devalue by 99.9%, it doesn't matter what your investment theory is with regard to choosing between real estate, bonds, and equity. Portfolio diversification is irrelevant. What you're doing is you're shuffling deck chairs on the Titanic. And so the big insight is the theory of economic relativity, or just understanding the Doppler effect, or understanding that it looks like the mountain is flying up in the air, but it isn't. You're falling, right? When you're falling with a big ego, you think that your investments are going up in value, but what's really happening is you're crashing to your death. You just have a big ego because you're arrogant, because you can't imagine having fallen off the cliff, right? So if I get you, high on drugs and you just fall off a cliff, you're like, I'm flying. No, you're not flying, right? You're dying, okay?
You're dying.
So in this particular case, if you have a big enough ego to assume that the country you live in will go on forever, and to assume that the currency that you breathe and the currency that you operate in will hold its value, then portfolio theory and economic theory and Keynesian theory and real estate analysis and equity analysis and stock analysis, all of these subjects matter. But literally, if I put you on the deck of the Titanic, the only, when people start screaming, the only question that matters is there a hole in the ship? Will the ship sink? And after you answer that question, the only other question is, how do I get off the ship? Right? And so I think that if you think about it that way, you have a bunch of economists for the past 100 years. They don't really appreciate monetary economics or monetary physics. Probably they haven't written papers that are informed by physics, engineering, informed by mathematics, and informed by cryptography, and the like. And so you started with an unscientific